Welcome back to the portfolio, everyone. And today we're doing a stock battle between Coca-Cola versus Pepsi. The two blue chip dividend paying stocks. We're doing a battle today to determine which one may be the better buy right now. We're going to take a look at which company may perform better and outperform the other over the next 5 to 10 years. Take a look at how these companies have performed over the past 5 years and just go over some key financial metrics, compare the current financial valuations for both of these companies, and determine which one may be the better buy right now for your dividend portfolio. So of course, we both know these companies, we both know what they do and how they operate. They sell a bunch of different beverage and consumer products to consumers, and they actually own and operate a bunch of other labels under their umbrellas of Coca-Cola versus Pepsi. So these two blue chip companies have huge dividend histories, strong, consistent dividend growth year over year, and are established companies that have been held within dividend growth portfolios for over 50 years. So we're going to break down each of these companies today, and as you know everyone, I'm the Gen Z investor, and every single day on this channel I come out with different videos about the stock market. We talk about different stocks you can buy, overall stock market performance, and any other stock market news and headlines that we need to go over. So please like and subscribe, and we're going to jump right into this battle between Coca-Cola versus Pepsi. First thing we're going to take a look at is the 5-year price chart for both of these stocks and determine which one has actually seen a better 5-year share price appreciation. If we move over to Coca-Cola first, you can see here on the 5-year chart they're up 15%. So they were hit hard by the March lows and have not yet fully recovered. 52-week range, they are trading somewhat towards the middle, which may make this a nice buying opportunity. So very minimal, only 15% share price appreciation over 5 years. If we jump over to Pepsi's share price chart, you can see much more price appreciation, up 43% over the past 5 years, but on the 52-week range, they are trading somewhat towards the high side right now. So that's how they performed with regard to share price appreciation, but because these are both long-term dividend-paying stocks, we have to take into consideration those dividends. So if we move over to Coca-Cola, you can see here, the total return for Coca-Cola over the past 5 years was 33.33%. That is with dividend returns included. If we jump over at Pepsi's, you can see they're at 61% total return with dividends included in that. So Pepsi's total return of 61% versus Coca-Cola's 33% just shows that Pepsi has actually grossly outperformed Coca-Cola over the past 5 years. So 5 years ago, if you were to make your investment to Pepsi instead of Coca-Cola, you would see much higher returns today. But compared to the overall market, they actually both underperformed, considering the total market with dividends reinvested returned 72%, and Pepsi, the outperformer, only returned 61%. Coca-Cola, of course, we saw, has only brought in 33% total returns over the past 5 years. So both of them underperformed the total market over the past 5 years, but Pepsi has almost doubled the return of Coca-Cola within that same time frame. We jump over to our spreadsheet, we're going to get into the first battle on this chart. And the first one is market cap. So market cap just shows how large the company is. Coca-Cola has a market cap of $205 billion. Meanwhile, Pepsi has a market cap of $191 billion. So Coca-Cola wins this battle, but a very slim margin. Only a $14 billion market cap between these two companies. And of course, every single day that market cap does fluctuate with regard to how the share price performs. And if, as tomorrow in the next couple of days, if Pepsi has it better than Coca-Cola, their margin may shrink. So Coca-Cola wins this margin, but both of these companies have a market cap at around the $200 billion range, meaning they're of somewhat similar size. And when we have these large companies, one thing we want to make sure is that they are bringing in huge amounts of revenue. If you have a market cap and you are trading at a valuation of close to $200 billion each, you want to make sure these companies are actually bringing in decent amounts of revenue each and every year. So these numbers we're going to take a look at for revenue are from 2019. So we're looking at a full calendar year, and I want to take the numbers pre-pandemic. So before the economic shutdown, I want to make sure these numbers were a good comparison, an equal playing field where the economy was actually doing very well. So if you take a look at total revenue over 2019, you can see here Coca-Cola brought in $37.3 billion of revenue, but Pepsi brought in $67.2 billion of revenue. So Pepsi brought in $30 billion more of revenue than Coca-Cola in the same 12 months, which is absolutely incredible to see. So if you compare revenue to market cap, Coca-Cola brought in $37 billion of revenue compared to $205 billion market cap, yet Pepsi brought in $67 billion of revenue versus $191 billion market cap. So nice little perspective to keep in mind with that. And of course, when we talk about revenue, we have to talk about net income and how much profit was actually made off of these revenues. And if we see here in 2019, Coca-Cola reported net income of $8.9 billion and Pepsi reported net income of $7.3 billion. So Coca-Cola beat Pepsi with regard to net income and profit, even though Pepsi brought in $30 billion more in revenue. And what that just shows is that Coca-Cola actually has a much higher profit margin within 2019. So profit margins may fluctuate year over year due to a bunch of different metrics, but within 2019, Coca-Cola's profit margin was at 23.86% compared to Pepsi's 10.86%. So Coca-Cola has a 13% higher profit margin within the same year, and even though they generated $30 billion less in revenue, they actually brought in more net income and more profit than Pepsi within the same 12 months. So that's how income statement kind of performed. And with regard to this income statement, it's very nice that Pepsi brought in more revenue and Coca-Cola brought in more income. But how is that revenue growing? So you have to take a look at how that revenue has grown over the past 3 years. So this is an average revenue growth over the past 3 years for each company. So the average revenue growth for Coca-Cola over the past 3 years is actually declining by 3.4%. So revenue on average over the last 3 years has actually been declining at a rate of 3.4% per year, which is not good to see. Meanwhile, Pepsi has been slow growth of 2.3% average annual revenue growth over the past 3 years. So of course we want revenue to go up each and every year. So Pepsi wins this battle because they do post a positive revenue growth and are beating Coca-Cola's revenue decline over the past 3 years. So of course, with these large companies, we are not expecting double-digit revenue beats each and every year, but we would like to see both of these companies do a better job of growing their revenue. Doesn't have to be anything astounding, but 3 to 5% revenue growth year over year would be solid for these type of companies. Moving on, the next battle is with regard to current valuation. So we take a look at both of these companies. We're taking a look at their forward PE ratio. So Coca-Cola's is at 26. If we take a look at Pepsi's, their forward PE is at 25.7. So at this battle, the lower PE ratio is who wins, because what a PE ratio is, it's comparing how much you would pay and how much investors are willing to pay per $1 of company earnings. So if you're paying less money per dollar of company earnings, that essentially means you're getting a better deal for the shares of the companies. So currently, Pepsi's PE ratio for their forward PE is 25.7. Meanwhile, Coca-Cola's is at 26. So although their PE ratios are almost the exact same, Pepsi slightly edges out Coca-Cola with regard to this battle, and they do win this small term battle. But of course, that is not much. I do believe they are fair to be trading at a similar valuation right now. Moving on, the next metric we have to take into consideration is the dividend. As a dividend growth investor myself, I'm a big fan of dividend companies. I invest solely into dividend paying companies that have a consistent history of growing that dividend payment each and every year. And both of these companies do just that. Current yield, if you were to start a position into these companies today, is Coca-Cola at 3.47% and Pepsi at 2.97%. So the higher dividend yield in this case wins this battle, and that goes to Coca-Cola with about a 0.5% higher dividend yield right now. If we take a look at their dividend history, Coca-Cola is a dividend king with a 57-year dividend growth history, which is absolutely incredible. If we jump over to Pepsi, they have an insane dividend growth history as well at a 48-year dividend growth streak. So they are very close to becoming a dividend king, and I'm certain that in the next 2 years they will reach that milestone, which is absolutely impressive. Both of these companies have continued to grow their dividends during economic recessions, economic depressions, and of course economic booms, which is absolutely incredible. Moving on, even though they have one company that's a higher yield than the other, we have to determine how sustainable that dividend is. We're going to take a look at earnings per share payout ratio, free cash flow payout ratio, and of course how safe that dividend is. But with regard to that dividend payment today, we want to see which company is actually growing that dividend at a faster rate. So it's very nice that Coca-Cola pays a higher dividend currently, but how do they compare with regard to dividend growth? So the 5-year average dividend growth rate for each of these companies, Coca-Cola at 5.57% versus Pepsi's at 8.4% average dividend growth over the past 5 years. So Pepsi on average has been growing their dividend 3% per year more than Coca-Cola over the past 5 years, which is a pretty sustainable beat with regard to Pepsi. So they've done a better job of growing their dividend over the past 5 years. Now, with regard to that dividend growth rate and dividend yield, how safe is the dividend? So I get my dividend safety score from Simply Safe Dividends, and how it shows is that Coca-Cola's dividend safety score is at an 80, which represents a safe dividend. Meanwhile, Pepsi's is at a 93, which shows it is very safe. Very unlikely that either of these companies cut their dividend anytime soon, but Pepsi is actually the higher rating and the much safer dividend. So Pepsi wins this battle with the higher dividend safety score. Now, like I mentioned before, we're going to take a look at payout ratios. So when you're evaluating dividend paying companies, it's very important to take a look at a couple different payout ratios just to determine, can this company sustain the dividend moving forward? how is this company paying the dividend? Are they generating enough free cash flow to pay the dividend? Are they paying it out with cash on hand? Are they issuing debt to pay out the dividend? You want to make sure the company and the dividend is sustainable long into the future. First payout ratio we're going to take a look at for these companies is earnings per share payout ratio. The most common payout ratio used, how much annual dividends a company pays out divided by the earnings per share for each individual share. So the earnings per share payout ratio for Coca-Cola currently over the past trailing 12 months is at 77%. Meanwhile, Pepsi is at 83%. So the lower percentage here wins this battle, and that goes to Coca-Cola because it just shows that whatever company is actually paying out less amount of earnings for their dividend just means there's more money left within the company to be reinvested in order to grow and improve operations, which just shows it's a more healthy and sustainable business. So Coca-Cola slightly beats out Pepsi in this battle and wins this. The next battle we have to take a look at is free cash flow payout ratio. Insanely high free cash flow payout ratios for both of these companies. This includes the last trailing 12 months, so of course it does include the quarter of their economic slowdown. So that is why their free cash flow ratio is somewhat inflated right now, because they did include their decline in free cash flow because they had higher expenses over the last 3 months and a little bit of a declining revenue. So the lower the ratio wins again, but these are both insanely high, with Coca-Cola at a 340% free cash flow payout ratio compared to Pepsi's 375%. So Coca-Cola wins this battle, and that's how the dividends stack up. Coca-Cola pays a higher yield and has lower payout ratios, but Pepsi has been growing their dividend, and their dividend is actually considered safer than Coca-Cola's right now. Moving on, we talked about the income statement, we talked about the dividend, we talked about the current valuation of these companies and their past performance. The last thing we have to take a look at is their current ratio, which is from the balance sheet. So the balance sheet represents a company's total assets versus their total liabilities, and what we have to talk about today is the current ratio, which is total current assets compared to total current liabilities. So this is the assets and liabilities you have on hand within the next 12 months. And what that shows is, can the company sustainably operate within the next 12 months with any risk of any hardship due to their high debt? So what you want to do, you want a current ratio at least above 1 for solid companies. Anything higher than that is just an improvement. Personally, I like companies that have a current ratio around 1.5 and higher. We take a look at the comparison between these two big companies. You can see here Coca-Cola's current ratio is at 1.09 versus Pepsi's 0.98. So Coca-Cola wins this battle with the high current ratio, but overall Pepsi is not too concerning because their current ratio is almost at 1, and I'm sure over the next 12 months they'll do some nice balance sheet adjustment in order to build up their assets, reduce some liabilities, and improve this current ratio to move forward. Overall, that was the final battle in this comparison. Coca-Cola actually wins this overall stock battle with 7 wins for Coca-Cola versus 5 for Pepsi. So you have to determine which company you may want to hold in your portfolio and which one you may think may be the better buy right now. But overall, if you can hold both of these companies, I don't think there's anything wrong with that. If you're looking for more dividend growth, Pepsi wins that battle. If you're looking for higher profit margin companies that generate more income per dollar revenue, Coca-Cola has done that over 2019. Overall, both of these companies have been providing investors with huge consistent dividends over the past close to 50 years, and either of these companies are well-established brands that I do not believe are going anywhere anytime soon. So if you go with one or the other, you actually hold both, I believe your portfolio will do very well over the next 5 to 10 years. So as you know, everyone, I'm the Gen Z investor, and I post videos every single day on this channel. If you have an idea or you want 2 stocks compared and a stock battle done, leave it down below in the comments, and I'll of course take a look at them and make a video and compare each of these companies in the next week's Saturday stock battle. So thank you for tuning in, and I will see you in tomorrow's video.